SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to this SUERF workshop on housing markets in the 2020s, valuation, drivers, risks, and policies. Real estate markets have been booming over the past decade. In many countries, prices have doubled in real terms. Various factors have contributed. Ultra-low interest rates and the search for yield and for safety. In German, we speak of concrete gold, Betongold. A growing scarcity of available land. Changing and increasing requirements on living space due to the boosts to teleworking as a result of COVID. And demographics, including migration. This workshop will investigate these drivers more closely. It will also discuss the question as to whether we are faced with a new real estate bubble or whether prices are here to stay high due to structural factors such as demographics, home office, and so on. Based on this, we will evaluate policy options, be it in the area of taxes, be it in the area of macropru, or in other areas, and how far central banks' inflation-induced current and future interest rate hikes may curb real estate credit and prices. We will structure our discussions into two parts. The first, analytical part, where we will seek to understand the mechanisms at play in real estate markets. And the second part, to evaluate policy options. We have a range of excellent and experienced speakers and moderators with us today from key institutions and top universities around the world. Let me give a warm welcome and thank you to Sylvain, Deniz, Anke, Manuel, Luiz, and John for sharing your time and expertise with us today. Without further ado, let me hand over to Sylvain Broyer, who will moderate the first session.
Thank you very much, Ernest, and good afternoon to everyone. Welcome to this SUERF workshop on housing markets. My name is Sylvain Broyer. I am the Chief Economist for the EMEA region at S&P Global Ratings, and I have the great honor of sharing the first session of this workshop dedicated to the questions of valuation, drivers, and risk. To provide answers to these questions, I have three distinguished speakers with me, all representative of no less distinguished institutions. We are delighted to welcome Deniz Igan from the BIS, Anke Wetzka from the German Bundesbank, and Manuel Muñoz from the ECB. Let us start with Deniz with assessment of developed housing markets risk in the wake of the pandemic. Deniz, please, the floor is yours.
Thank you very much, Sylvain, and thank you also to Ernest and Dragana for the organization, and thanks to all of you for joining. I look forward to a nice conversation and exchange of knowledge and views. So before I start, this is what I'm going to present today is joint work with colleagues at the BIS, but also former colleagues at the IMF. Nina, Shemshu, Emmanuel, Furichai, and Adam and Emishe provided excellent research assistance putting this together. And needless to say, the usual disclaimer applies. The views are mine and should not be attributed to the IMF or the BIS. So what I want to talk about today, let me start by showing you, where are we as far as house prices go. Now, before the pandemic, you see for different country groups, the typical, the average house price changes, year-on-year price changes. And before the pandemic, real house prices seem to have grown at a steady rate in both advanced and emerging market economies. And starting in 2020, just around the onset of the pandemic, you start seeing a divergence. And house prices in emerging market economies, the yellow line, continues to grow at a slower rate, while the growth rate for advanced economies picks up. And more recently, we start also seeing a further divergence that is appearing among advanced economies, house prices increasing slowly or at a slower pace in the euro area, but they are continuing to grow at a fast pace in others, most notably the US. You see the blue line topping all others there. In my remarks, I want to focus on that boom phase, as I'm going to call it, the boom in advanced economies. That's not to say there are not interesting things happening in emerging markets, but I'm going to focus on advanced economies given this divergence. And what, if any, what are the risks from this boom that we have experienced in advanced economies? Now, house prices, as Ernest also mentioned, house prices rose strongly in this group of economies during the pandemic. In some cases, it was more than 20–30%. What is also interesting is that this is a striking break from what we had known, what we had observed in the typical post-recession patterns. What you see there on the left-hand side is over the 4 decades up to 2019, we look at downturns and what has happened to house prices around those downturns, with the vertical line showing you at 0. The peak. And what you see is that real house prices tended to remain stagnant. They fell and then they tend to remain stagnant longer than even nominal house prices. Nominal house prices would go down, and after about 4 quarters, they would start recovering. Real house prices remain stagnant even longer. During the pandemic and the post-pandemic recovery, we didn't even see a temporary dip. Those are the dotted lines you see there. And as inflation rose, we see a wedge between nominal and house price, real house prices. But the fact that the upward march continued remains. In addition, this episode is also interesting or atypical compared to what has happened in the past when you look at credit market developments. We haven't seen significant change in credit growth before the downturn. In the past episodes, we would generally see households first building up leverage, faster credit growth, and then households during the downturn would unwind that leverage and reduce their leverage. Recently, we're now starting to see some weakness in household credit growth, driven by the rising interest rates, where the dotted lines start, rates going up and credit growth going down. But you don't see this build up and then unwinding phase that we had seen earlier. Now, what explains what has happened this time around? I will argue that there are a range of factors that shape this unusual behavior. First, economic activity recovered much faster than we had expected if we go back to 2020. And of course, this was no accident. We had higher saving rates, which boosted financial wealth. We had fiscal support in many of these countries, unprecedented fiscal support that raised household income. And monetary policy, generally speaking, has been very highly accommodative. So these exceptional, easy financing conditions obviously boosted demand for housing. And we had the strong liquidity positions of households, financial wealth increasing, and income recovering very, very fast and being supported by policy measures. So what that means is that households, anybody looking to be an owner-occupier, could, at least until recently, borrow at very low interest rates. And you can see that, borrowing costs, these financing conditions did play a role in what we have seen. You can see that in the international synchronization of house prices. And what I show here on the left-hand side is the proportion of house price movement across countries that could be attributed to a common global factor. And the pink line is telling you that since 2016, more than 60% can be explained by this common global factor, which is general financial. Right? This ratio was about 40% between 1995 and 2015. So this is not very surprising. The pandemic itself was truly global, and the policy reactions it induced in different countries was also common across these countries. So we see that global pattern going in. The other thing, again, on the financial side is that what is the alternative, right? And on the right-hand side, we looked into how did gross rental yields compare to bond yields. And you see that gross rental yields have been well above bond market returns in advanced economies. We look at emerging markets, you don't see a similar pattern. What that means is that dwellings become very attractive assets, and there's even if you're not going to owner-occupy as a buy-to-let segment, they become very attractive. So even with recent increase in interest rates, the blue dots are showing you the latest bond yields on the 10-year sovereigns, and even with that increase, rental yields are still attractive. And besides the search for yield, I would like to also mention that there is a perception that real estate can be an inflation hedge. So that probably also supported this return calculation that the investors had in mind. Now, at the same time, yes, financial factors explain some part of what we have seen. At the same time, pandemic was special, right? And what we have seen is shifts in preferences, which increased demand for space and didn't make a big difference whether you were in the city center anymore or you were farther away. So that resulted in relative price increases as well as overall price increases. And what I mean by that, this increased demand for space and changes in preferences basically clashed against limited supply in many countries. And supply bottlenecks were also influential on leading to large and at the end, at least partly reversed increases in construction material prices, like lumber prices going up and down and reaching levels that we hadn't seen in decades. And as usual, as ever, housing supply has been constrained by land availability, by zoning and building regulations. And in some cases, like the United States, there's also years of underbuilding. So we entered the pandemic, this shift in demand came at a time where supply was already stretched. What we saw as a result then was overall strong growth in prices, but in particular for properties that offered more space. And you can see that in the yellow bars that are showing the cumulative increases in house prices in different countries for houses. These are single family houses, detached houses, versus apartments. And you see the gray bars are much lower. So house prices increase much faster than apartment prices did. And you can also see that in terms of the location, what we're showing on the right-hand side is an average for major cities in the US, Boston, Washington, DC, Chicago. And what you see is that in the red line in 2015, is your commute time increased, price appreciation would go down. Right, so the city centers, properties in the city centers would enjoy higher price growth. Whereas you look at the blue line in 2021, you see the reversal. City centers didn't experience almost any price change, whereas those farther away from the city center, properties located farther away, experienced faster growth. This donut effect you might have heard of, that was shown in some MBR papers. Now, the big question, of course, is what is next, right? Prices obviously have soared relative to incomes, and they are historically high, and this is especially true in small open economies with the standard, house price to income or house price to rent ratios or model-based estimate that also take into account the impact of interest rates. But no matter how you look at it, compared to pre-global financial crisis, pre-GFC, in the heat map there, the current valuations, current indications seem to raise much more red flags. As I said, this is particularly in countries like California, Canada, Australia, New Zealand, Sweden, Norway. Those are where we see some issues. Now, an exercise that we have done to study how housing demand could interact with higher interest rates, we use the asset pricing framework. and we're linking house price rent ratio to user cost, which then depends on capital gain expectations and the mortgage rate. And here the idea is that we're assuming that these capital gain expectations are extrapolative, so they capture speculative demand based on what investors have observed in the past on price gains. And this can be a driver of very relevant driver of house prices, especially when interest rates are low. So the search for yield behavior we're trying to capture. So what we do then is estimate this model based on the US data, and we use it to project nominal house prices under different interest rate paths. If you just assume interest rates would remain constant, this exercise was done in March last year in the red line, you see that the model predicts a further appreciation because of the speculative demand going on in nominal house prices about 20% further between 2022 and 2025, and then a reversal going down from there. And the reversal happens because the user cost depends on the expectations. So if price fall lowers the expected capital gain, which further reduces speculative demand for housing, and the price correction kind of accelerates. Of course, interest rates didn't stay constant. In March, we were thinking, okay, let's look at 100 basis point increase in interest rates. Let's look at 200 basis point increase, and thinking a gradual tightening of monetary policy. Then the effects that I mentioned on the speculative demand side would be muted, right? And you wouldn't have the boom-bust style house price adjustment with speculative demand you get. So you would kind of achieve a soft landing. This is what the blue and yellow lines are showing you. Now, interest rates have risen more, and they risen faster than what we had expected back then. Does it mean there's a hard landing coming? Perhaps the kind we had gone through back in 2008. The short answer is that's not necessarily the case. And this is because there are important mitigating factors to consider. And there's a large literature showing over and over that what makes house price boom busts so dangerous is actual leverage. So when house price booms coincide with credit booms, the chances that we can avoid a financial crisis or an economic downturn, or both for that matter, are very small, right? So looking in the current episode is good news that we do not have that twin boom pattern. You see in the first chart that the pre-GFC, you have the clear association between change in household credit ratios and change in house prices. But before the pandemic arrived, if anything, we had a negative relationship, and post-COVID, we have basically no significant relationship. And as Anke will talk about it more, it's not only the quantity, but also the quality of credit that provides some comfort. And what I mean by that is lending standards have been largely prudent this time around, and the banking system is also in better shape. And of course, this is in no small part thanks to the post-GFC improvements in the regulatory and supervisory framework. So learning our lesson from there, this provides some degree of comfort. Now, this does not, of course, mean price reversal and associated macrofinancial stress can be fully ruled out. And here I want to focus a little bit, let's look at the subsets. We talked in general. But you look at household debt. Yes, there's in the set of countries that we're looking at, there's no significant relationship between credit growth and house price growth. But household debt fell in major economies, in the large AEs, in US and Germany, for example, but it continued to climb in small open economies along with house price appreciation. So that association exists if you just keep on cutting the sample, right, in some countries. And in some cases now, household debt is almost twice annual income in these countries. And the distribution also matters. It's not only, household debt overall grew, but the service burden can weigh on much more on already heavily indebted households. And the service burden is also sensitive to higher rates in countries where mortgages tend to be floating rate rather than fixed rate. So as I mentioned, we look at different countries. Again, the small open economies kind of lead the pack in terms of where a change in, say, 100 basis point higher interest rate would weigh more on the lower, the most indebted quartile of households. But again, as I mentioned, a key mitigating factor here is the better cushions we have in the banking system. But again, another parenthesis is that there could still be hidden vulnerabilities in the financial system that could amplify these dynamics. And they could, for example, be coming from the non-bank financial sector, as Manuel is going to talk more about. Now, then, other than macro-financial stress, there's another issue we need to think about, and that's affordability. Now, in ongoing work, we have calculated a housing affordability index for 40 countries. In most cases, the series go back to 1970s. And this index captures basically the ratio of median household income to the income needed to qualify for a typical mortgage in that country to purchase a median-priced home. So for those of you who are familiar with the US, this is basically what the National Association of Realtors calculates for them, and we're expanding it. And what you see when you do that exercise on the left-hand side is, generally speaking, housing has become more affordable, especially after the global financial crisis. Prices fell, they came back to earth, but at the same time, so did interest rates. So the lower interest rates made housing more affordable, generally speaking. Now, rising house prices have already stalled this process. You see the flattening for the median country in our sample. But in some cases, such as the US, where we show on the right-hand side, affordability has actually worsened over the past year. And with further interest rate increases in the horizon, it would be no surprise that this trend would continue and we would see even more affordability issues coming to the fore. So let me stop here for those of you interested. Dragana is going to post the slides and you can explore these links for work at the BIS as well as the IMF on current housing issues. Thank you.
Deniz, thank you very much for this presentation. I don't see questions in the chat, so maybe let me start with maybe two words you said during the presentation, and I just catched up the question of soft landing and affordability. So you talked about very dynamic and atypical developments in terms of price development for many housing markets in developed markets, and in the US probably even more than in Europe. First question on affordability. It looks like that for it takes much more time for many US households to save money for down payment on their housing than before the pandemic. So, question of affordability: is housing still affordable? Is the dream of accessing to housing property for US citizens, but also in Europe, is it still in reach for most of the population or not? Is there shares of the population now excluded from this stream of accessing to housing property? That would be my first question. And the second question on soft lending. So you said, for instance, the relatively low level of leverage in many economies, especially the larger one. The quality of credit is still good. So it might, a soft landing might be the baseline scenario, but would you completely exclude the scenario of a hard landing? And what about a repeat of the 2008 scenario? My two questions to you. Thank you.
Great questions. Let me try to be brief on whether the American dream is lost. Now, if you looked at, in 2020, OECD keeps a very nice housing affordability data set across countries. They try to make it as comparable as possible. And if you looked at the latest data they have, 2020, if I'm not mistaken, the median ratio of housing cost to income in the US for households was about, say, 18%, 19%, which put the US pretty much in the middle among OECD countries. So it didn't look like affordability is a big issue. Now, since 2020, things changed, obviously. Two things I would like to point out. One is the house price changes and rent changes that happened over the past year, right? Over the past year alone, rents are up about 15% nationally. House prices are up more than 25%. So, and interest rates over the past year, again, are up more than 250 basis points. So if you assume the 20% down payment still applies, even with that, the median household is facing about 600, 700 more in their mortgage payments, just with these changes. So what that means is that the mortgage payment to income ratio for the median household was about 23% last year, and already hit 35% this year, right? And that is a big thing. And you're thinking, okay, 35, is that too much? Well, 25 is what we generally think is good. 40 starts raising alarm bells that housing is not affordable. And in the past cycle, at the peak in the fall of 2005, this ratio hit 41%, and then we started house prices downturn coming. So looking at these patterns, there's something in the overall, right? Then the second point to make, one thing is, yes, things are not moving in the right direction. The second point, again, a worrisome sign, is that I talked about the median household, but there's a lot of variation across households as well. And again, the numbers, the lower quantiles on the income distribution, even back in 2020, they spent 38% of their income on housing, renters or owners, right? So obviously for them, housing is already unaffordable. And another thing that happened during the pandemic is that these households often either they didn't have the opportunity to benefit from telework, their jobs are not executable from home, so they couldn't just move out to more affordable places. And those who were already in more affordable places actually experienced this in the chart that I showed, the donut effect. The richer households moving away from the cities and coming to suburban areas, to rural areas, actually squeezed them more with the increase in housing costs. So with those two observations, I would say we will see much more and possible policy actions as well. But this inequality aspect in particular is going to be something to watch. On your second question, Sylvain, it's the $1 trillion question. Yes, and I'll answer as most economists answer. I believe there's no ruling out either scenario. We would continue to hope for a soft landing given the reforms that have been done over the past 10, 15 years, and hope for the best. But we cannot rule out less favorable scenario. I still am thinking this same, repeat of 2008 is not going to be something we're looking at. But that doesn't mean that there's something that we don't quite understand, and after the fact it's going to become clear, and we need to be very vigilant, especially on the non-bank financial intermediation side. Thank you.
Can I raise a question?
Of course, please.
I've got slight reservations about the simulations of the US house price to rent using the US house price to rent ratio. In work that John Duca and Anthony Murphy and I did, we found that loan standards were a very important part of that relationship. So historically, you might be misrepresenting the relationship. And then going forward, big question is, how are loan standards going to evolve? If there were difficulties in the financial sector, loan standards might well deteriorate quite sharply, and then that would have an additional impact on the potential downturn of house prices.
Very well received John. We actually had some discussions with John Duca while we were doing the exercise, and we caveated much more in the written version than I presented here. But you're absolutely right. We need to take it with a grain of salt.
Doesn't look like so. I would say, looking at the clock, it might be time to go to Anke and assessment on weather and maybe how overheated is the German housing market. Anke, please, floor is yours.
Hello, everybody, and good afternoon. I will focus on the German housing market and especially the assessment of overvaluations from the Bundesbank perspective. In Germany, we observed strong housing price increases since 2010. You can see that in the chart. The increases were first a little lower and then heightened during the time span. And this upswing started very heterogeneous with stronger price increases in the cities, as you can see in the green bars. And those differences decreased since 2016, around 2016. And since 2019, the growth rates across regions assimilated. So the growth rates in the rural areas are now relatively similar to those in the cities. Although I have to say the price levels in the cities are still really higher than in the rural areas. The rising prices were mostly demand-driven with ensuing supply expansion. The indicators you can see here show no weakening of price dynamics during the COVID-19 pandemic so far. And recently, you can see that in the middle, the orange bars show that the growth rates stabilized on a high level. So the growth rates in 2021 rose, at least if you look at the indicators from VDP, which is Verband Deutscher Pfandbriefbanken, and the statistical office, the violet bars. But the first quarter or the first half of the year showed that the growth rate is not further increasing. A special factor here are the currently high costs for construction, especially material costs increased strongly as a consequence of delivery bottlenecks. I think Deniz already mentioned that. But according to our analysis, the price growth is still mainly driven by the price increases of building land, like it was in the years before. The building land is showing that land is the most impossible part of the house price development. As a consequence for the rising prices, our analysis show that overvaluations in cities and in Germany overall rose to between 15 and 40% in 2021. In addition, we find more indications of price bubbles in the last year than before the pandemic. And now let me show you how we come to this assessment. There exist numerous methods to assess the valuation level of house prices with very different advantages and limitations on both sides. So I will show you one very common method, the standard indicators like the price to rent and the price to income ratio. Usually, we use the deviations of one of the ratios from its long run mean to obtain a measure for the valuation of house prices in this case, but you can do that with any other asset as well. Why do you have to use the long run mean? It's important to have a whole life cycle and not only a boom or a bust period to compare with the actual data you use for your assessment. One problem in Germany is to build the long run mean because we have several advantages concerning the data. We had the reunification and also the data supply is not pretty good concerning the housing market. So we don't have all sectors like apartments and houses for a long period, and that makes it a bit difficult to have long run means which are really showing the German market as a whole. But for some indicators we can calculate them, and as you can see in the left picture, you see the deviations from its long-run mean for the price-to-rent ratio in the cities and in the 7 largest cities, but not for Germany overall. However, we have the deviation from its long-run mean for the price-to-income ratio in Germany overall by using a constructed house price index we calculated at Bundesbank. As an interpretation of the results, according to these standard indicators, we had overvaluations in 2021 in the cities and in Germany overall between 30 and 35%. In the 7 largest cities, the overvaluations were even higher with around, 40%. You can see that in the blue line. On the right side are the ratios pictured, not the deviation from the long-term mean, with an additional ratio marked in red. But let's first look at the other 2 ratios. You see the price-to-income ratio for Germany and the price-to-rent ratio for Germany as well, with a huge upward swing during the last 7 years, more or less 10 years. But in the beginning, it was not so obvious. But since 2015, the upswing is really remarkable. But currently, the ratios have a kind of a sideways movement, so it's a bit lower, or it's not rising like in the years before or in the quarters before. On coming to the red line, that's the annuity to income ratio, which is an indicator for the affordability of residential real estate. We already saw that in Deniz' presentation, and it takes into account that house purchases are mostly financed by mortgage loans, where the mortgage interest rate plays an important role for the affordability of buying a house. So for this ratio, we calculated an annuity of a hypothetical mortgage loan. It's probably similar to the to how Deniz did that affordability indicator. The higher the red line in the picture, the worse was the affordability of credit-financed house purchases at that point. So despite the extraordinary large price increases since 2010, first, the affordability according to this indicator has improved because of the decline of mortgage rates. But since 2016, the mortgage rates didn't decline further, and against the background of continuing price increases. So that led to a deterioration of the affordability back to the level we had before the financial crisis in 2009. So you can see the last point is really rather high, and that's because interest rates couldn't get lower anymore, and the last quarters showed that the mortgage rates rose a little bit, and that pushed the effect a bit more. So these standard indicators are quite easy method to assess the valuation level of house prices, but they don't take into account some further determinants which are important for house price developments. That's why we use additional econometric methods, for example, a panel estimation approach. This model estimates fundamental prices for each year and each of the 400 regions in Germany using a Hausmann-Taylor instrumental variable approach. And we estimate the model yearly because we get the data once a year. We do a second estimation in the beginning of each year just for the cities, because the data for the cities, we get it a bit earlier. But for Germany overall, the estimation is calculated on a yearly basis only. The approach takes into account several variables representing supply and demand aspects. Included in the specification are the stock of housing per capita, disposable income per capita, the population density of a region, the share of the middle-aged population as the potential house buyers, the long-term expected growth rate of the GDP per capita as a measure for for the expected income, because we don't have data for the expected income, so it's kind of a proxy variable. But if you want to buy a house with a mortgage loan, and then it's not only important what your income is today, but also what your income will be in the future years. So this is an important variable in our estimation. And last but not least, the rather most important part is the long-term real interest rate for mortgages. We also estimate a scenario in which we fix the real interest rate on the level of 2009. It's kind of similar to Deniz, but we are estimating the past, and Deniz estimated the future development. Why did we choose 2009? There are several papers who analyze the natural interest rate for Germany and come to the conclusion that the interest rate from 2009 was rather close to its natural level. Why the natural level? We want to estimate the fundamental value for house prices. And for that, we have to use kind of the fundamental value for all the determinants we put into our estimation. And we would think that the considerably low interest rates are not the fundamental value. So that's why we chose to make a scenario estimation as well as the estimation with the actual values. By comparing the results of these two specifications, we obtain information about the effect of the exceptional low interest rates after the financial crisis in the euro area, which gives us additional information. The outcome of the econometric approach is that in 2021, overvaluations particularly increased outside of cities. So also we still have considerable overvaluations in cities. So the overvaluation spread over Germany overall. That's in contrast to the years before, where we had overvaluations, especially in the cities of Germany. The widespread of 15 to 40% after many years with is owed to the large insecurities, incorporated in econometric estimations in general, but also is this stemming from the actual situation due to the effects of the pandemic. Some variables like the income dropped in the beginning of the pandemic, but came back quickly fast, and the expectations I mentioned before, the expected growth rate of the GDP per capita had a boom, because during the pandemic people expected the GDP to get back to normal values quickly, fast, and so this number had to be somehow smoothed a little bit, and so these are insecurities we have in our estimation. We have to take into account that we can't just say a number and say that's the truth for the overvaluations. Of course, the year 2022 was still affected by the effects of the pandemic. I already mentioned the weak development of income, additional savings, or the regional relocation of housing demand. That's something Deniz said already, because the demand of housing, especially from house purchases, so that are often people who can work from home and might be able to move outside from the cities, and that's kind of a switch in the demand in Germany. And but however, according to our calculations, these effects don't have a noteworthy impact on the overvaluation results. We see but what we see, on the other hand, is that over-optimistic expectations of households became more important than before. That's why we took a good look at those expectations. For that assessment, we use information from the Bundesbank online survey about the expected development of prices and rents for residential real estate. So the survey takes place each month, and households are asked several questions about different different topics, and but one part is the housing part and what people expect from the house prices in Germany. And one question is, what do you expect with the house prices in the next 12 months, increase, decrease? And once a year we ask the households if to give us a number, if they expect house prices to rise by 10%, 15%. It's an open field, and the same questions, we have the same question for rents. So we can say, okay, households think that house to rent ratios will increase or decrease or stay the same. In line with the notion of a bubble by Stieglitz, we define destabilizing developments as the combination of overvalued residential real estate in a region on one side, and the expectation that the price to rent ratio in this region will increase further. Why is this important? If a household knows there are already overvaluations in my region, then the normal economic reaction should be, okay, the market should go back to normal and in a normal functioning market. But if the expectations are in a way that the overvaluations will increase further, then that's kind of a destabilizing price development. And that means we combine the results from our panel estimation with the household expectations from the Bundesbank online panel. Also the panel estimation I showed you before, there we get fundamental values and with that overvaluation measures for each region in Germany, and can combine that with the results of the online survey, of the online panel. And compared to 2019, so that's prior to the pandemic, the number of regions with destabilizing expectations increased considerably. So you can see that in the yellow columns in the picture. 2019 we were below 15%, and in 2021 45%, nearly 45% of the overvalued regions showed destabilizing price developments. That means in 45 regions, the most part of the households expected increasing overvaluation. A segmentation of the additional number of regions with destabilizing expectations from 2019 to 2021 shows that the increased optimism of private households is crucial for this development, rather than a further increase of regions with overvaluations. So that's an important point, that this the additional regions from 2019 to 2021 are stemming more from expectations than from overvaluations. So that was in the year 2021. We can have a look at the current development of expectations. We cannot make the same analysis here because of a lack of data for the estimation of overvaluations, because the data for 2022, we will get it in April 2023, but in the chart you can see the mean and median of the expected changes in real estate prices. And both measures decreased considerably in the past half year, but households still expect prices to rise. The mean and median growth rates are still positive. This also applies to the subset of regions with overvaluations if we separate them from the data set. Okay, so we now know that households expect a considerable reduction of the price growth rate in the next 12 months. Does that mean the boom in the residential housing market is abating? It's kind of the glass bowl, but the demand for housing weakened because of inferior income perspectives and increasing mortgage rates. I think that's not really surprising, and we heard that before. On the other hand, is the expansion of supply subdued, especially due to material shortages. We observed a slowdown of construction permits since April 2022, which might result from insecurities stemming from the war in the Ukraine as well. So we have to look into further data, but it's one point which adds now to the insecurities from the pandemic. This might be an additional sign for weakening demand, but also shortens the supply and has therefore an upward effect on the prices, all else being equal. What we see too is a high demand for residential mortgages, which is caused by higher construction costs and the motivation to save actual interest rates in the expectation of further rising interest rates. So households want to save the lower interest rates now. However, the bank lending survey shows that banks expect a decline of credit demand in the third quarter 2022. On the next slide, we can see the dynamic lending during the last decade, which increased the household indebtedness. And like I said, the rising interest rates may have created incentives to front-load borrowing. And the new lending is still dynamic with some weakening more recently. You can see that in the thin lines, I hope you can see it, which show the quarterly data in the upper picture. The relatively long interest fixation periods of housing loans shield borrowers from an immediate exposure to the rising interest rates. So they don't have an immediate effect on the wealth of the households. Around half of the new mortgages have a fixation period of 10 or more years, which means that at the end of that period, a substantial part of the loan is going to be paid off. Another risk factor is the possibility of rising unemployment, which might endanger the stability of the housing market. At the moment, the market is the employment market is stable, but we have to see the future is very insecure because of what happens in the world today at the moment. Okay, another important information from financial stability perspective are the lending standards for housing loans. We already mentioned them. During the boom, there was no substantial loosening of lending standards. The upward trend of the LTV for new loans was interrupted by the pandemic and is falling since then. And the debt service to income ratio shows that the falling interest rates more than compensated the increasing prices before 2015. It's kind of similar to what we saw in the affordability index before. Since then, the DSTI increased a bit, but not that far like before the upswing. The further development of lending standards is uncertain, but although a tightening of credit standards is more likely in the actual situation. At this point, conservative income-based lending standards like the debt to income or debt service to income will be key to keep the risk in the flow of mortgages limited. Okay, as the time is running now, let me sum up rather quickly. We saw exceptionally high rates of house price growth during the pandemic, which didn't intensify further recently. And in the last year, the overvaluation spread spatially and rose to between 15 and 40% in cities and in Germany overall as well. Likewise, the risk of destabilizing price developments increased in the last year. And recent survey data show a considerable reduction of expected house price growth rate, but scarcely price decreases. And last but not least, the large share of long interest rate fixation periods of housing loans shields the borrowers from rising interest rates, so it's kind of a security cushion. Okay, I think, thank you very much. So I think we should go to the questions. I cannot see them. I will stop sharing so I can see the chat. I think that's better. Or, oh no, I can see it now.
Thank you very much, Anke, for your assessment of the German housing market. So it looks like Germany is not escaping the general trend of rapid growing house prices. I must say I was struck by one of the charts you show on the 127 cities with that showed that the price to income increased as much as the price to rent, more or less. And I must say, so for me, my understanding of the German housing market is, especially the market for rents, is that it's an extremely regulated market. So I would have expected the price to rent ratio to rise much more than the price to income, and that's not the case. So that's wow. That was my wow moment on your presentation. Other things, so you mentioned 15 to 40% overvaluation on the German market in a context of rising interest rates, risk of a shallow recession next year that could impact the labor market. So maybe same question as to Deniz. What about the risk of a bubble busting in the German housing market? You gave one part of the answer with this strong increase in population we have in Germany right now with the refugee, probably more than 1% increase. That's a huge positive shock. So maybe that's not a bubble busting, that the main danger, but an acceleration in housing price dynamic for Germany. But other things, then I see we will also answer the questions that we have in the chat. But maybe so. You made allusion at the level of interest rates. So you did not explicitly say that interest rates are too low for Germany, but that's what I understood from your presentation. And given the context you depicted, if interest rates are still too low for the German economy, what can the German regulator do to lean against the wind on the housing market effectively? That would be my question. And then maybe a question from the audience on whether you consider foreign demand and a shift of preferences in demand for housings in your overvaluation assessment. Thank you.
Thank you, Sylvain. So I would not say the interest rate is too low for Germany. I would never say that. But yes, I think it's not a secret that the euro area is very heterogeneous. So, and the rate has to decide on interest rates for the whole area. It won't fit to each region. If you make an interest rate only for Germany, if you would make an interest rate only for Germany, then it also wouldn't fit for each region separately. Maybe some rural areas would need another interest rate than some cities. So I think it's it doesn't help to discuss if the interest rate is good for Germany. We are in the euro area with all the benefits, and I think that's what we should work with. And to lean against the wind is a bit difficult with that construction that the ECB is responsible for interest rates. But what do we have? We have macroprudential instruments. In Germany, we have the Financial Stability Committee. Some instruments are in work now. The CCYB and the Systemic Risk Buffer are active. And I think that's what each nation in the euro area can do with those, to work with those instruments to secure that we don't walk into a financial crisis. But yes, and I would say that monetary policy is, in addition, the monetary policy is not only for the housing market. So it's difficult from the beginning to say, let's do something to help the housing market dampen down. So I think it's too crude to take real estate prices into account, and monetary policy should focus on its mandate, which is price stability. And we have other instruments to work on the housing market. So the question from Dragana, thank you. No, from Carlos. Thank you for the question. Yes, foreign demand is an important point, especially when the interest rate was really low and prices were rising, but we don't have data. That's our biggest issue in Germany. We don't have sustainable data for each of the aspects we want to know. So that's very difficult to get data on this point. For preference shifts, that's a bit difficult too, but we had in our online survey a question that was last year and in the year before, if the household would consider to move into another area because of more possibilities to work from home. And that's some kind of a preference shift, like you mentioned, and not especially for space, but I would include that because then you need an office in your house as well. And the respondents, or the number of respondents who wanted to move because of that was really, really low. I was surprised by that myself, but it was so low that we said, okay, that won't have much of an impact on house prices in the rural areas. So I can tell you that much from our survey, but even here in that point, we don't have more data considering this aspect.
I think then it's time to turn to Manuel and the role of institutional investors in housing markets for the final presentation of this first session.
Okay, so the role of institutional investors in housing markets. I would like to highlight, first of all, that the usual disclaimer applies and that the views I'm going to present are my own and do not necessarily reflect those of the ECB or the Eurosystem. So regarding the outline of the presentation, let me say that first of all, I'm going to summarize and highlight recent trends and key features of institutional investors, mostly the real estate fund industry, adopting or from a global perspective. Then I will move into an assessment of the patterns shown by these institutional investors in EU area housing markets. And finally, and as a way of building a bridge with the next session of the workshop on policy measures, I will draw some policy considerations and touch upon some macroprudential policy matters. And then I will finalize with some concluding remarks. So first of all, let me say that since the onset of the global financial crisis, there has been a steady increase in real estate institutional investment. And in my view, this is to be attributed to two key factors. First, a low interest rate environment, which exerted a downward pressure on fixed income and triggered a search for yield in alternative markets, importantly in the real estate sector, and a reform of the prudential regulatory framework, which, as you know, affected or constrained comparatively more the banking sector. As a result of that, we experienced a structural tightening of bank mortgage lending standards, which, in my view, again, had three key implications that are relevant for the purpose of this presentation. First, and which are reflected in several empirical studies and that I'm referring to in this slide. First, this tightening has revitalized rental housing markets. There has been a depression of home ownership rates in many countries and an increase in rental supply. The presence of institutional investors and in particular of real estate funds, I'm using the acronym RAVES for them, has increased steadily since then. And the Basel III framework has imposed a burden on real estate companies and has incentivized them to rely comparatively more on non-bank funding sources. Regarding the increasing presence of real estate funds in housing markets, I would like to highlight that there's an empirical study that shows and identifies a causality relationship between this increasing presence of institutional investors and the recovery in housing prices and investments in the aftermath of the global financial crisis, that these large-scale buy-to-rent investors have pushed prices and rents upwards over the last decade, and decreased affordability to some extent by having a capacity to set prices in the neighborhoods where they have concentrated. And a study by Deniz Igan shows that investors are, from all the different types of housing buyers, those that are comparatively more constrained and affected by regulatory loan-to-value limits. Now, this is just to give you a little bit of motivation. Over the last years, and especially prior to the COVID crisis, the media recurrently reported many statements and comments by market analysts and by real estate professionals, which clearly showed how concentrated this sector is. There's just a few players basically controlling the market in what is clearly a global business, as many of these players operate in many different countries, including different countries in the EU area. And how year by year this the size of this industry and of this market has been increasing, with real estate assets being a very important component of portfolios of some of the largest and more important funds in this regard. And in addition, many of these statements that were reported pointed to the fact that these housing investments were largely being financed by direct lending, not coming from the banking sector, but from debt funds and other non-bank financial institutions. And at some point, there were some experts pointing out that there was a risk of a bubble in credit, which was not coming from banks, but from debt funds. And now, after having given you this very brief overview of the sector and the general patterns and key features from a global perspective, let me now switch or move to the main patterns of this sector in the EU area housing markets in recent times. First of all, by using data from the ECB investment fund statistics, I saw in a paper co-authored with Frank Smets that in less than a decade, real estate funds and real estate investment trusts flows in the EU area have more than quadrupled. Nonetheless, I would like to highlight, and this is relevant also for the remainder of the presentation, that there's limited data availability regarding this sector. And the fact is that in 2019, the ESRB already issued a recommendation requesting authorities to close data gaps on housing investments. So, but at least patterns seem to be consistent with those of data provided by private providers. And what it is clear is that this expansion in this market has been fundamentally being financed by borrowing. And in fact, when we look at the ESRB non-bank financial intermediation risk monitor of this year, for the expert judgment table they have regarding certain risky activities in which non-bank financial institutions are engaged, what we find is that for the spectrum of investment funds, when we look at real estate funds, together with hedge funds, these are the type of funds that are most engaged in leverage, and leaving money market funds aside, they are the most interconnected funds in the industry, which relates again with statements relating their interactions with other types of non-banks, such as debt funds. And interestingly, when we look again, at least the patterns can give us an idea, even if data should be interpreted cautiously. given the complexity of many of their operations. What we see is that the leverage ratio over the last years of real estate funds have been higher than those of any other fund types in the European Union. And interestingly, when looking at the right-hand side panel on credit intermediation, we see that actually it's bond funds, those that have been relatively more engaged in credit intermediation activities, presumably with other relevant actors such as real estate funds. Now, more on real estate funds and leverage, what we have to say is that these funds operating in the EU area are generally not subject to leverage limits because they fall within the type of funds subject to the Alternative Investment Fund Managers Directive, for which no leverage limit applies, that there's uncertainty surrounding actual leverage measures of real estate funds, among other reasons, because funds often lever up synthetically through the use of derivatives. And there's recent evidence, and I'm here citing 2 ECB papers from my colleagues, that show that fund managers in leverage funds react in a more procyclical manner, and that leverage amplifies financial fragility in the investment fund sector. Now, when looking at this figure, which was published in the ECB Financial Stability Review of May 2020, we can have an idea of the size of this sector in each of the domestic economies in the EU area. We find that the Irish property fund sector is one of the largest ones in the EU area. And this is very interesting because recently the Central Bank of Ireland launched and carried out a deep dive survey of the Irish real estate fund sector, collecting plenty of valuable data. The main findings are summarized in a financial stability note that was published in February 2021 by the Central Bank of Ireland. And to summarize a lot, they identify benefits of this increasing presence of property funds in housing markets because they contribute to a diversification of the sources used to fund housing investment, and also because they provide with investment that supports the domestic economy. But on the other hand, they also identified potential risks to financial stability, namely liquidity mismatches and high leverage ratios, with an important role being played by non-bank funding. They show information on the leverage ratio of the Irish fund of the Irish property fund industry, and with this, I'm going to move to the next section on policy considerations to sort of build a bridge with the next section on policy measures. First of all, I would like to highlight that over the last years, the European Central Bank has repeatedly stated that the macroprudential regulatory framework for non-banks is in its infancy, and that a further strengthening of this framework would be relevant to tackle structural vulnerabilities and to strengthen the sector's resilience. In the Financial Stability Review of May 2022, which is the latest edition, the report explicitly states that the use of leverage by non-bank financial institutions is a key financial stability concern, which needs to be tackled by enhancing the policy framework along 3 dimensions, which I'm not going to get into the details of in the interest of time, but which again relates to aspects that I'm already touched upon, which are the leverage of these funds and their reliance on non-bank funding, the diversification or the diverse nature of their funding sources, and the fact that they can lever up synthetically through derivatives, which brings additional complexity into the monitoring of these trends. And secondly, and quite interestingly, just some months ago, in November 2021, the Central Bank of Ireland published a consultation paper on macroprudential measures for the property fund sector in Ireland, building on the results of the deep dive survey I just mentioned, proposing two new macroprudential tools to safeguard the resilience of this growing form of financial intermediation, so that it is better able to absorb rather than amplify future adverse shocks. These two macroprudential policy measures are guidance to better align redemption terms with liquidity of assets, and ultimately to mitigate issues related to liquidity mismatches, and a macroprudential leverage limit. Now, regarding the macroprudential leverage limit, I have to say that this limit would be imposed through existing regulation under the Irish transposition of the already mentioned directive, in line with ESMA guidelines on the application of Article 25 of this directive, which were published in 2020. And interestingly, the ESRB highlights that this will be the first time that this article, which allows for national authorities to adopt leverage limits in the investment fund industry, provided that leverage represents or can contribute to the buildup of endogenous systemic risk. It would be it's going to be the first time that will be triggered in Ireland and possibly in the European Union. And what is even more remarkable, in my view, this leverage limit, despite the fact that it's not the first leverage limit that is being adopted at the national level in Europe, it is going to be the first macroprudential leverage limit, strictly speaking, because the publication explicitly states that the central bank may temporarily remove in the face of adverse shocks, or tighten in the event of an exuberance in housing markets, the corresponding leverage limits, meaning that it would be able to adjust it in a counter-cyclical fashion. And this is precisely what I started analyzing and proposing already in mid-2020 when I published an ECB paper entitled Macroprudential Policy and the Role of Institutional Investors in Housing Markets, which has recently been significantly revised and co-authored with Frank Smets and published by the ESRB, and which was cited already back in 2020 by former central bank governor Honohan as a novel and interesting proposal to start addressing systemic risks stemming from the non-bank financial sector. Well, to summarize, in the interest of time, I would just like to say before concluding that what we find in this paper, in which we calibrate a macroeconomic model that captures the key features of the real estate fund industry to quarterly data of the EU area, we saw that there's existing leakages of existing macroprudential regulation, because since there's a certain sector, the non-bank financial sector, that is relatively less regulated from a prudential perspective than the banking sector, this existing regulation could trigger a destabilizing credit reallocation towards the relatively less regulated sector, that by complementing existing regulation with a macroprudential leverage limit or a similar tool such as a counter-cyclical LTV limit on the non-bank lending that is obtained by these funds, improves the capacity of macroprudential policy to smooth the financial cycle and to induce social welfare gains. And In addition, we saw that the proposed policy measure would also contribute to a less abrupt increase in competitive prices in rental housing markets during the boom, and therefore it would be less of a need to consider measures that have also been considered, in some cases adopted in certain countries, such as caps on prices in rental housing markets, which, as we know, can induce some distortions in the economy. So in conclusion, over the last years, over the last decade, there has been a steady increase in real estate institutional investment since the global financial crisis. This pattern has the potential to bring economic benefits for the economy where the real estate assets are located, but importantly, it can also entail financial stability risks. But recent studies show that by adequately designing and implementing macroprudential policy, these risks can successfully be prevented, and this framework can contribute to them to benefits to be materialized. Thank you very much.
Thank you very much, Manuel, for this picture on the on institutional investors, and also a slight shift into the second session of this workshop on policy recommendations. Maybe so. One question I had. So you say that the increased presence of real estate investment funds has definitively some economic benefits, diversification, and so on. There also be a risk to financial stability, but on balance, would you say that the European housing markets are more stable with an increased role of funds, or less stable than before? And maybe also to come back to a previous question, how is the price and rate setting evolving with this increased participation of investment funds in the housing market? Is the price more elastic to interest rate changes, or less? Same for rents.
Thank you very much for your questions. So on the first question, so that's a very good point. So I would say again that we have to differentiate between the structural change that happened, which is that due to certain structural factors, the presence of institutional investors steadily increased in housing markets already when many economies were in a downturn, and from that perspective, one could say that they can play a stabilizing role, which is important. But looking forward, and from a purely cyclical perspective, what we saw is that they have the capacity, and given the way they operate, they have the tendency to amplify fluctuations with potential implications for the real economy, and therefore their stabilizing role would be certainly more, or it would be better defined if under an adequate or a more comprehensive macroprudential regulatory framework that is more developed for the case of non-bank financial institutions. And second, related to your second question, and coming back to a question we had before, so we don't have estimates of what has been the precise impact of the increasing presence of institutional investors on rents, and how that's and what is going to happen with that in the future. But what is clear is that from from the empirical evidence, we know that rents are less volatile than housing prices. And second, that this increasing presence of institutional investors in rental housing markets and partial switch from the home ownership market to rental housing market relate to a structural change which is still in place. So my response would be that in any case, even if there's a significant downward adjustment in housing prices, any changes in rents are going to be more moderate.
Okay, thank you very much to our speakers. Maybe to conclude, and before handing over to Ernest for the second session, just a very few takeaways from me on this session. So maybe four. First, we have had very dynamic and atypical development in terms of prices, housing prices since the pandemic in the US, probably even more than in Europe. Sometimes these price developments are self-reinforcing due to over-optimistic expectation, as we have in Germany. Second takeaway, the outlook is more for a soft landing, so the risk of nobody can exclude the risk of a hard landing, given that interest rates are on the rise, and how the labor market might react to the sharp slowdown in the European economy we will have in the quarters to come. That will be important to monitor for the housing market. There are definitively fragilities. Anke talked about 15 to 40% overvaluation in the German real estate market, according to some metrics. And finally, there are important fundamental changes in the way European housing markets especially are financed, with a strong rise of institutional investors that make the landscape a bit different. Probably more stable, but also bearing some risk of financial stability. So many thanks for this very good session. You listened to Deniz Igan from the BIS, Anke Wetzka from the Bundesbank, and Manuel Muñoz from the ECB. Now, let me hand back to Ernest for the second session of this workshop. Ernest, over to you.
Thank you very much, Sylvain, Deniz, Anke, and Manuel. We now have an excellent basis to discuss policy issues. We have two excellent speakers with us. First, Luiz de Mello, a director at the Economics Department of the OECD. And second, John Muellbauer, professor of economics at Nuffield College, University of Oxford. I directly hand over to Luiz.
Thank you very much, Ernest. It's a pleasure to be back with you for this seminar. What I'll try to do is to start off by looking at some of the indicators, let's say the scene setting numbers that some of them have come up already. But just to give a cross-country perspective on those issues, if you look, for instance, at house prices and rents, and here, I think it's important to distinguish house prices from rents to cover exactly all the different dimensions of real estate markets. So it's no surprise to anyone the orders of magnitude of the increases that OECD countries have experienced over the last 15 years or so. You see that in most cases, house prices have, blue bars there, have risen faster than rents, but in many cases also sharp increases in both elements of housing costs overall. Again, as it was mentioned before, the prices have continued to rise since the pandemic, or the onset of the pandemic at least. This chart is not about prices, but it's about rents, just to again give you an idea of the magnitudes of the increases that a few OECD countries have had in the year leading up to the summer of 2022. Of course, most of these increases are in nominal terms. The positive ones are in nominal terms. The inflation surprises that we've had this year explain some of the drops in real terms. But the rents and prices, I'm not showing the graph for prices, but the prices have also continued to, or rental values have also continued to rise during the pandemic. The issue of affordability has come up. I just wanted to give you or to share with you two different indicators of affordability, since one point that we've been trying to make is that affordability has various dimensions to it. So one indicator that I find particularly useful is the share of housing expenditure in household consumption. And then you see that on the base of that metric for several OECD countries, housing expenditure has continued to rise over the last 20 years. So it's basically, you see the situation, the latest number that we have in 2020, and you see the black dots for the year 2000, and you see that most countries have had a continued increase in housing spending as opposed as a share of consumption. Another indicator of affordability that is interesting to look at has to do not with the averages across markets or averages for countries, but essentially how much housing costs represent in terms of overall consumption baskets of the poorest segments of society. So basically that indicator is the share of households in the bottom quintile that spend more than 40% of their disposable income on rent, mortgages, subsidized rents or not. And then you see a very wide range of situations across OECD countries, with the interesting point is that rents are typically, or that social group, when households are overburdened, it's essentially because of unsubsidized rents, or rents in the unregulated market, if you want. Unregulated, of course, in inverted commas, because there is always some sort of regulation applying to the unsubsidized sector as well, much more so than the case of mortgages. And I think that explains why certain countries are putting so much emphasis on tackling affordability issues in the rental segment of the market rather than the mortgage sector itself. I'll probably come back to that later on. So I would say that these are the a few interesting indicators that give you an idea from a cross-country perspective of the situation that policymakers are facing. Another important consideration that we've been taking into account is obviously the implication of, if there is an affordability problem, the implication not only for spending shares and so on, but also on the living conditions. And again, unsurprisingly enough, you would see that wide variety of situations in OECD countries in terms of essentially the share of households that live in overcrowded conditions. So, and you have that for across income groups. I think the interesting point there is not that the poorer segments of society tend to be living in overcrowded households. That is, I think, in everybody's prior, but also the fact that even median income households sometimes tend to be in that situation. So that's basically as a general overview of the key of the situation in different countries. Let me move on to policy considerations. And here, just to be clear from the beginning, I want to focus on longer term structural drivers of price increases rather than some of the issues that were talked about in the first panel that relate predominantly to short-term developments, those related to financial conditions and monetary policy stance and their effect on price developments. But essentially, when we look at the longer-term drivers of housing costs, and here I'm referring to costs as opposed to house prices or rents, basically to include both situations. According to the analysis that we've done, essentially you have a number of key drivers on the supply and the demand side. The demand side, essentially, demographics and income, and demographics including immigration, as was correctly pointed out before. Those two factors tend to account for a large share of longer-term changes in house prices. But there are other policy-related elements that need to be taken into account. A number of them related to the tax treatment of housing assets and income. I'll come back to that, spend a few minutes on those, because they are important not only because they may create incentives for a preference for a given types of tenure structure. There are certain features of the tax system, for instance, that would encourage a preference for home ownership. Then basically you are putting rental markets at a disadvantage, and so on. The interactions between housing income and personal income, again, through the tax system, are important considerations to bear in mind. And needless to say, the important issue of the design of property tax systems themselves. On the supply side, a very important constraint, which has to do with geography. It's a fact that parts of the world, cities, especially local markets that are very constrained by geography, tend to have a much lower elasticity of supply to demand signals, if you want, than areas where you don't have that. If you have a coastal city with a complicated geography, you would have typically harder constraints on the ability of supply to meet increases in demand than otherwise. But there are other elements of policy that are important to consider. Land use regulations and zoning, for example, landlord-tenant regulations that again make race incentive for supply responsiveness and so on. And a final point that I'm going to come back to is about construction costs. A lot has been said nowadays about the impacts of value chain disruptions as economies emerged from the pandemic, issues related to the availability of construction materials and so on. These are important considerations, of course, but there are other cost pressures that the industry is facing related to tighter standards in terms of energy efficiency of buildings and so on. So very important objectives, needless to say, but that may impose construction costs that in turn affect supply and supply responsiveness to demand channels. So let me take you quickly through all these channels. Demand, on the demand side, demographics and income growth. You see wide variation of situations across the OECD countries. Population growth over the last 30 years on the left, for example. Some of those countries, it's not only the population growth rate of the native population, but also taking into account migration flows. You see on the right again, growth rates of per capita income over the same 30 years in a variety of OECD countries as well. And it's no surprise that in some of those countries where population growth has been rapid or income growth has been strong, that there are also sharp increases in house prices, especially where supply responsiveness tends to be lower. Housing taxation, this is basically to give you an idea of the different instruments that are at play in most OECD countries. You see that essentially recurrent taxes on immovable property are the ones that basically are the instruments that the most common one across the OECD membership. But you also see in certain countries still some reliance on financial and capital transactions taxes that apply in the case of real estate transactions, and other taxes related to state inheritance and gift taxation. recurrent taxes on net wealth as well, that obviously add to the overall tax stake on property. But the important role here of recurrent taxes on immovable property, given their prominence as a tax instrument in the OECD area. Tax relief is not uncommon. You see, basically what this graph does is to show you the marginal effect tax rates that apply to housing. You see that in some countries to the right of the chart, there is considerable tax relief. A very popular one being essentially related to interest payment on mortgages. So those are, again, as I mentioned at the very beginning, some tax incentives or tax relief measures that encourage demand for people to buy houses. So that creates, again, preferences for certain tenures and with implications for the supply responses across other tenure types. That's an important consideration also to bear in mind. Some countries that have the practice of taxing imputed rent in the case of owner occupiers, other countries that don't do that. So basically, essentially, we try to, with this exercise, to take a look at, let's say, standard practices across the OECD countries and to have an idea of how the presence of relief in some cases could affect the marginal tax rates that are essentially the deciding factor, both for investors when it comes to buying a home, but also for home occupiers as well. It is a fact that many countries underutilize their property taxes, but they may underutilize that, and that you can see by the very different shares in GDP that are basically accounted for by in terms of revenue of property-related taxes. One case is obviously that we see in many parts of the world is basically outdated registers of properties, or essentially tax being levied on property whose value for tax purposes does not correspond or is out of line with market valuations. In other cases, it's essentially very low taxes being levied on property in general. Why is this important? Well, for a number of reasons to do with efficiency, equity, and the actual functioning of housing markets that I don't need to elaborate on, but also because recurrent taxes on immovable property those revenues account for a large share of the revenue base of subnational governments. And we know how important subnational governments are in many of our countries as a provider of services, as essentially a layer of administration whose revenues need to be commensurate with the mandates that they have on the spending side. And recurrent taxes on immovable property are essentially one of the best revenue sources, given the nature of those tax instruments for subnational layers of government. So a point here that goes beyond price developments, but also to draw attention to the importance of looking very seriously at those types of taxes when it comes to real estate markets in general. Another point that I wanted to highlight regarding demand, because demand is shifting. I think that there was already a reference to this issue in the first panel. Demand is shifting not only because of the underlying factors that I mentioned, demographics, preference, and so on, but also because of the pandemic. And here I don't need to spend too much time on it. What is important to look at is, how are those shifts in demand affecting prices and rents, and where exactly, so that we understand if the affordability challenge is changing also in nature and in magnitude, it's important to know where that is happening. So we are doing work for a number of cities. I think that's again a parenthesis here. It's an issue that needs to be looked at a level of granularity that is far more complex than country or regional averages to really understand where the pressure points are. So just the two examples of two cities among the ones that we are looking at: Budapest and Lisbon. And then you see here essentially that the price pressures, the districts they're shown on the maps in red, are the ones where prices have risen the fastest since the beginning of the pandemic, or since pre-pandemic benchmarks, based on pre-pandemic benchmarks. And those areas tend to be outside city centers. So the city centers there are identified with this black target mark. And then, if you take into account the fact that it is outside city centers where demand is growing fastest, areas where typically you tend to have a higher concentration of lower income households that are already overburdened to begin with, then you see that the pandemic has had other shifts in demand triggered by the pandemic, have the scope also for aggravating the affordability problems that many metropolitan areas had experienced even before the pandemic. What is that doing in the aggregate? So just if you take a look at the chart on the left, the difference between the red and the green lines seem small, but they're economically meaningful. That essentially is the gradients that you had before the pandemic and since the pandemic in terms of price differentials as a distance to central business districts. So that essentially corroborates the idea that demand is shifting in a way that is putting upward pressure on prices in areas of the cities that are furthest from city centers. We don't know if this is a phenomenon that is here to stay. To some extent, it's likely to be the case, given that we are seeing, at least anecdotally, that some of those shifts in demand have not been reversed, at least entirely, since the reopening of economies. But it's important to monitor that going forward because of all the demand side issues that I mentioned. But also, if you want to understand how supply will adjust to that, it's important to know where that is happening and the type of price impulses that you can expect to have as a result of that. Final word, land use planning, an important consideration, again, an important driver of prices there. The numbers that you see, it's basically an indicator that we did here at the OECD on land use governance. The higher the bar there, essentially what it tells you is that you can expect inefficiencies related to either overlapping of responsibilities across different levels of government or too much fragmentation in the sense of decisions being taken at too local a level that may then favor the capturing, if you want, of certain areas, certain parts of cities and metropolitan areas by the interests of local residents that may put a cap on the expansion of supply in a way that would favor rapid increases in prices under certain conditions. Let me the final word, and I hope I still have 1 minute or so, Ernest, if you allow me. A point related to rental market regulations. These are very important in specific segments of the market, but in general, in terms of, when you have a situation of very strict regulations in terms of rent control, for example, or landlord-tenant regulations that favor one of the two. The issue here is not say who you wanted to favor, the landlord or the tenant, but essentially how you strike a balance there that does not create a disincentive for the expansion of supply by people who would hesitate to put property on the market, on the rental market especially, because they feel that that is basically putting too hard a constraint on their return on the investment on real estate. So in real estate. So this is also an issue that affects a variable, a type of regulation, a type of policy that affects supply responsiveness according to the work we've been doing. I mentioned, and this is really the final one, the issue of cost pressures in terms of construction. You see here that the decarbonization in the housing stock is an important element of overall decarbonization goals in our countries. Let's not forget, buildings account for about 1/5 of emissions. So if you basically leave aside that important part of that source of emissions, you're bound to have difficulties reaching decarbonization targets. The work of the IEA, the International Energy Agency, around the different scenarios, the ones that you see there, the red bars about a net zero emissions scenario that they do, and possible paths for emissions in the housing sector in general. So fairly ambitious targets there to assure consistency with net zero emission goals, and the fact that real estate is a difficult, especially the residential segment, is a difficult one to decarbonize for a number of reasons we don't have time to go over now, but especially the fact that housing has a very long life cycle. The share of new houses that are built every year is very small relative to overall housing stock, and the overall housing stock then has in it essentially or is based on technologies that may not be the most efficient in terms of the most modern energy standards. So it's a very important element of decarbonization in overall strategies to contain emissions, and that may impose costs, or in fact, it may impose, no, it will impose costs that will have to be borne. So thinking of financial instruments that can meet that demand while not creating additional upward pressure on prices would be an important goal for policy moving forward. With that, Ernest, I'll stop here. Thanks for that, and I look forward to the to questions and discussion. Thank you.
Thank you very much, Luis, for this comprehensive overview. There are basically two sets of questions in the chat. One question relates to national differences, and building on that, what drives the national differences? Now, you gave a very comprehensive overview of many different factors that drive them, demand and supply. My question to you, and maybe then also to John, would be, are there studies that bring together all these driving factors into one framework through some comprehensive econometric model? And the second set of questions relates to regional differences. So, you know, even national developments mask massive regional differences. You and other speakers, you know, made reference to the effects from COVID and so on, but it's not only these effects, it's further effects that come into play here. And the question is, of course, is even a national real estate policy, national tax changes and so on, is this adequate given the vast differences within countries? Thank you.
Very interesting questions, Ernest, and thanks for colleagues for raising that. In terms of studies, I would say that there is one study that I used that is done by my colleagues here at the OECD, and you can find a reference to that in the slides, the main slide on the demand and supply factors. Is one that essentially tries to do this, to have one single long-term model of supply and demand for housing, in which we try to interact and use all those policy instruments that I mentioned throughout the presentation. It will be a pleasure to share that with you, but if you go to the website of the OECD, there in the page that we have on housing, you'll find some of these references that may that will give you some more elements related to supply elasticities, to changes in supply elasticities, and some simulations about longer-term drivers. And the other question about the regional variations, I think that's a very interesting question, because some of the the policy instruments that I mentioned a minute ago tend to apply at the national level. Certain elements of the tax system pertaining to personal income, for instance, tend to apply at the national level, but this is not necessarily the case of other features of the tax system. And local taxation tends to be very local. In many countries, especially the more decentralized ones, very important features of the design of local property taxation are essentially done at the local level. So that you have, in and of itself, already an element of policy design and implementation that creates this regional variation. Many elements related to landlord-tenant relations are also designed at the very local level. Issues related to rent control, some mechanisms for the adjustment of rent, some mechanisms for the use for eviction, for instance, in some cases are designed and implemented at the subnational level. And that goes for all the other aspects of zoning, all the aspects of land use regulation that are extremely potent when it comes to defining supply, and they are defined and they are designed and implemented at the local level. So I think the message here, Ernest, is that housing issues in general, housing markets need to be looked from a very clear local lens. Because of a lot of what's happening happens at the local level because of geography, because of the physical characteristics of what we were saying, but also because policies tended to be done, again, designed and implemented in a centralized manner. So looking at national averages, looking at even regional averages can give you very misleading pictures of what's happening in fact in housing markets, especially over extended periods of time. Thanks.
Thank you so much, Luiz. I think this is now a good time to turn to John. John is one of the experts in the world to go to when it comes to real estate markets. John, over to you.
Right, thank you so much. It's a great pleasure to be back in this extremely stimulating workshop where I've already learned quite a few things. I want to talk about three policy issues: monetary policy and housing, macroprudential policy, and tax reform. So on monetary policy and housing, I'll begin by talking about the link between inflation and house prices and rents, and differences between the US and the Euro area, and then go on to look at transmission channels. So we know that in the US, that the CPI core index has a weight of nearly 40% on an index of rents, which proxies owner-occupied equivalent rent. And what we found in some work some years ago was that we could forecast US inflation much better than Phillips curve models by including house prices, as well as unit labor costs and international prices in the forecasting model. And there's a very slow transmission from house prices to inflation, which we think works mainly through rents. And of course, rents are sluggish and respond slowly to house prices. Now, these issues have really moved up on the agenda of public discussion in the last few years, and there's a lot of recent work that is on the same lines. And this Bloomberg story, if you want to know where inflation is headed, look at rents, is very much in line with this. And the implication is that in the US, the upward pressure through rents is continuing. And that means that the US Federal Reserve may have to keep rates higher for longer. For the Euro area, things are different because the CPI excludes unoccupied rents. However, for France, we find that we can forecast the rent index pretty well 1 year ahead, including a model with house prices. But there's a very slow feed through because rents adjust slowly to existing contracts. And of course, there are rent controls. From other European Euro area countries, there's an even stronger weight on controlled social rents in the rent index. And so the transmission from house prices to rents is much more moderate in many countries. Now, there's been very little research in the euro area on this potential transmission channel of house price costs of price or wage inflation. But we do know that house prices seem to feed into perceived inflation. So, I think this is a topic that really needs to be investigated. To summarize, the US euro area differences in transmission are very considerable. They arise from the lack of the OER and the CPI and structural differences. That is going to help to explain differences in the monetary policy stance that you can expect. So on the question of transmission to aggregate demand through housing and mortgage markets, in a recent paper given at the ECB forum in Sintra in June, I looked at these questions, and I find it's really crucial to control for variations in loan standards to estimate the effect of the policy rate on aggregate demand. The transmission channels involve obviously policy rates to mortgage rates, then to house prices, to residential investment, to debt, to wealth, to consumption, and to non-performing loans, and potentially growth expectations. So it turns out that loose loan standards are a major cause years later of higher non-performing loans, and in turn, higher non-performing loans feed back on tighter loan standards, exacerbating the downturns. So this links potentially with what Manuel was talking about. If there's a credit contraction because of problems of over-leveraged rights, that could exacerbate the downturn. So we find that in France, using a latent variable method, we can forecast the NPLs with considerable ability. It's already been said that country heterogeneity is very big in the euro area. Here are some of the factors that matter. So the housing supply elasticity, whether there's access to home equity loans, the extent to which past house price appreciation is extrapolated. That depends on whether home buyers are more heavily geared, and also on whether property taxes are linked to current market values. Maturity mismatch is an issue, and more generally, the structure of the financial system, degree of leverage, and so on. Interconnectedness, as Manuel pointed out, really matters. So in making this assessment of monetary policy in the housing channel, 3 key points I think need to be made. First of all, the impact is varied a great deal by country, as I've just pointed out. It's tended to be overstated. So in other words, if you think that lower interest rates have had a terrifically strong effect on aggregate demand via housing, I think you're going to be wrong. One issue, of course, is the higher debt levels on consumption. And we find that higher debt has a major negative effect on consumption. And then there's the negative affordability effects of higher house prices on non-owners. In Germany, that's a really big issue. And then there are seriously negative side effects on inequality, particularly intergenerational. And recently, a lot of evidence has emerged in the literature that credit-fueled real estate booms have crowded out more productive investment with negative consequences for sustainable growth. So let me just point out some of these papers because it's a really interesting developing literature. There's Müller and Werner, who look at an amazing data set of 116 countries since 1940, looking at the sectoral allocation of credit, show that not only is there a risk of financial crisis, but also productivity slowdowns. A paper by Durr for the US, similar finding, but he points out how the mechanism works. It works through the relaxing collateral constraints for companies that own real estate. Chakraborty, similar finding. Paper on Spain, a paper on China, and a very recent Vox EU, particularly relevant for the Eurozone, pointing out there's a very strong connection between gains in total factor productivity and real estate, a negative connection. So let me make a few comments on the new macroprudential framework. I think it's just important to start by pointing out that the work that's been done by the ESRB, the EBA, the ECB, the country central banks, and of course the BIS and the IMF has really improved the functioning and the strength of the framework. And given the heterogeneity that I've pointed to, in Europe, we don't have a one-size-fits-all approach to real estate macro. So that makes it a necessity to have supranational bodies and the national central banks regulators coordinating. The supranational bodies have played an important role. They've improved cross-country data monitoring. They've developed new instruments, and they've sought minimum standards on the legal perimeter for macro measures. But at the moment, for example, loan to income or debt service ratio limits are not available in national legislation in Germany and Finland, and that's something that really should change. Now, the ESRB issues warnings of risk buildup, recommendations for tightening, and then checks on implementation. And in my view, this has been very good given the crisis that we currently face. Nevertheless, I mean, how adequate is it? Well, there are serious gaps in historical data. The risk dashboard is pretty incomplete, and the borrower-based toolbox is incomplete. So the assessment of how effective macro-pru is on real estate, a lot of missing research there. Now, in this Sintra paper for the ECB, I've argued that the latent variable method of measuring loan standards could improve the risk dashboard and improve the effectiveness tests a lot. So what the latent variable does is it looks at a set of equations for house prices, mortgages, and consumption. And after a full set of economic demographic controls, what's left is loan standards. And this latent variable turns out to be tremendously significant in forecasting the French NPL ratio. So just to summarize the findings, a perfect storm that would push the French non-performing loan ratio high would be a rise in interest rates, a rise in the unemployment rate, a fall in economic growth, a fall in the house price to income ratio, and crucially, loose credit conditions in the previous 4 to 5 years. Now, fortunately, as previous speakers have pointed out, credit conditions in the previous 4 or 5 years in most countries have not been very loose. So that's one good thing. So just have a quick look at Germany. Anke's paper I thought was very, very interesting. And I think what I'm saying is pretty much in line. But this online credit site, Europace, provides data on the loan to value ratios. And amazingly, in Germany, apparently, there are quite a few housing loans that have more than 100% loan to value. And the ratio of loan to value is over 90%. has actually risen since 2017. And the mortgage interest rate has gone up from 1% to 3.2% in June. So that's a shock. And according to Europace, which has very up-to-date data, the August data show that nominal prices are beginning to fall. Because Germany has its own risk factors, but just to compare the Netherlands, in the Netherlands, households on average are much more heavily in debt and much more invested in illiquid equity, and therefore much more exposed to potential asset price falls. And they've also had a really terrific recent rise in house prices. So at the moment, house prices are still rising, apparently, but it's one to watch. Leaning against the wind was mentioned in one of the questions earlier. In the euro area, leaning against the wind is really hard to implement because of the institutional differences that I pointed to. I think it's worth pointing out that globally, leaning against the wind would have been less damaging than the policies actually followed after the financial crisis, because fiscal policy could have been expansionary. And the high real estate valuations that we now have, with negative consequences for stability and sustainable growth, are pretty unfortunate consequences. And I think it's also important to say, and this is very much in line with what Luiz was just saying, that failures by government to correct housing supply distortions and promote stabilizing measures have made the problem much worse. So in terms of the risk outlook, one issue is real estate an inflation hedge? At the moment, negative real interest rates are about as negative as they've ever been. And with negative real interest rates, levering up to pay back housing loans in devalued currency seems very attractive. And to me, that suggests that particularly controlling leverage on commercial real estate and buy-to-let residential, as Manuel was suggesting, where risks are potentially quite serious, controlling leverage would dampen inflation expectations. And then, of course, there's climate change, where Europe has an even bigger ratio of CO2 emissions in terms of total emissions than the world as a whole. And what we need is holistic policy, as the OECD has been saying. This overlaps with points I've previously made at the last presentation at SUERF. The brick by brick document makes some very good points about transaction taxes, moving away from transaction taxes towards annual taxes on immovable property. Points out many benefits that arise from that. Now, the new tax report has a lot of discussion of regressivity, and of course, mortgage interest tax relief is hugely beneficial to more affluent households. It's an important difference between countries in the regressivity or not of this tax system as a whole. But I do find that the OECD has to be politically correct, and there's some reluctance to call a spade a spade. So even though the UK's council tax is mentioned a number of times, there's no mention of the fact that it's highly regressive. And these two graphs show that it's individually regressive. So people in the lowest priced houses in A pay a much higher tax rate as a fraction of value than those in the highest priced houses in Group H. And regionally, the poorest regions have by far the highest average tax rates. In Sweden as well, in 2008, the tax deform, I would call it, changed a progressive system into a regressive one. And of course, we know that in the US, there's regressivity of assessed values for property tax. I think one issue that is really quite hard to analyze quantitatively is the question of localism in tax rates. Because in my view, it helps to explain locational and other inequalities. And the mechanism is very familiar. More affluent families move out of poorer areas, reducing the tax base that funds education and other amenities. And then tax rates then have to rise to try to cover basic public services. But that makes those locations even less attractive. So you have a vicious circle of decline. So I think an interesting research puzzle would be, could we compare outcomes with a counterfactual, where instead of having very local tax rates, there are state or nationwide property tax rates. I think we really don't know how important this is, but potentially very important. And finally, let me go back to something I've talked about before, namely the green land value tax, which is a type of split rate tax that the tax report recommends. In my view, it has a great potential to resolve conflicts between affordability and equity in meeting climate goals, and also to reduce intergenerational injustice and social exclusion. And the idea is that there's a standard per square meter charge on land, and then you get a discount on the building depending on its energy use, a maximum discount for an energy neutral building or for a garden. And then regular revaluations, and everyone having the right to defer the tax. I think a really crucial element in this is to avoid complexity. So the tax authority would register a proportionate interest at the land registry equal to the unpaid tax for each year deferred to be settled when the property was sold or transferred. I think that is really crucial because it undercuts the typical crocodile tears that the rich, the landowners shed whenever property taxes are mentioned. And they always refer to the poor widow in an expensive house suffering from cash flow problems. So for green mortgage pricing, the use of EPCs, this kind of tax change could be a big improvement. So let me finish there and look forward to some questions.
Thank you very much, John. I think there were two interesting points in your presentation and in your remarks on which Luiz might want to react directly. I took note of the regressivity of real estate taxation, and also the interesting point, if I may formulate like this, the ghettoization effect of local real estate property taxation, the segregation effect. I think this also ties in with a point made by you earlier, Luiz. But I would like to add two questions. One was a provocative question, which is informed and provoked by SUERF's last webinar, where Jon Danielsen presented his latest book on the illusion of control, where he questioned our ability to predict and prevent financial crises through ratios and these kind of things. You know, many of the presentations here used indicators to detect whether we are in a real estate bubble or not, whether there is overvaluation of what. To what extent can we rely on such indicators? And then a final question, which I find quite burning in my country, but I suppose this is similar in other countries. Luiz referred to climate change and the energy transition and its impact on housing markets. And I think, John, you also alluded to that topic. But of course, more immediately and more urgently, the question arises, what about the immediate impact from exploding energy prices and from feared shortages of energy on housing markets? So will big property, not energy efficient property, lose dramatically in value? Will this reverse the moving out of the cities because of transport costs and the heating costs of all these single family houses that we heard about before? I think this is an immediate and quite burning question.
Shall I just come back on the question of financial crises? The indicators that we have are pretty imperfect because, of course, they're backward looking. The house price to rent ratio is so institutionally dependent. Rents in many countries are controlled. They're not a good indicator of the opportunity cost. Other factors like exuberance, expectations, which may be realistic of future growth, are important for some of these characteristics. And of course, one has to control for loan conditions and for interest rates in measuring any of these effects. That's why I think this latent variable technique is potentially so useful, because what it does is it kind of solves the Sherlock Holmes problem. Sherlock Holmes is faced with a crime and a number of suspects, and essentially by ruling out each of the suspects in turn, he finds the criminal. So that's the latent variable technique. You control for all the other things that are going on, and then what's left is the criminal. So you look at the joint behavior of all these housing-related indicators, and that is, I think, more helpful in extracting what the underlying process, dynamic process is. And certainly one important element that's been mentioned, Anke made a big point of it, is expectations. This extrapolation of expectations is something that is very important and depends on leverage and on history. That's something that our big survey paper on international house price developments really highlighted. And something where housing economists over the last 30 years have really shifted towards agreeing that extrapolative expectations are important. So measuring how exuberant these expectations have been in the recent past is important for figuring out what the risks are. And then, of course, the size of the shock that's hitting the economy is also crucial. The nature of the shock. This time, it's the energy shock is very different from previous shocks. So I think the point you made about shifting the pattern of house prices between big, expensive, energy inefficient houses and cheaper energy efficient apartments, I think that's a very good point. It's something that we should be seeing.
It's always hard to speak after John because there's nothing left to be said, but it's always a great pleasure, John, to be on this panel with you. But let me get back to this point that you mentioned, Ernest, about the energy price shock that we are facing, particularly in Europe. Because I think it's a very good opportunity to raise awareness about some of these issues related to housing. I mean, one is to distinguish between the different uses of energy in housing, right? One is a direct use of energy, which is essentially about appliances and energy efficiency of the building is located. The other one, the indirect use of energy through essentially, electricity use by the housing stock. Those are separate issues that need to be dealt with in coordination, but as separate issues. I would say that it's very important now to basically raise awareness about the fact that energy retrofitting in buildings is relatively slow. It doesn't happen to the extent that is needed to bring the whole housing stock to the standards that are desirable. That there is an amount of regressivity here that is impressive in the sense that the most energy inefficient dwellings are the ones that are occupied by the poorest segments of society, typically, especially in the rental market. So they tend to spend it's regressive because they end up spending a much higher share of income on energy than more affluent social groups. being in the rental market creates a problem of having to deal with the split incentive between landlords and tenants for investment in improving the energy efficiency of homes. And another important issue that needs to be dealt with on the financing side is essentially to create the incentives for banks to operate in this market in ways that can reduce the cost of borrowing for households who wanted to borrow to finance energy retrofitting investment. For mortgage holders, for instance, to possibly reduce the cost of mortgages to the extent that spending less on energy by investing in energy retrofitting, they can essentially improve their credit worthiness and then make sure that that is passed on to borrowing costs. So a number of measures, both on the demand side and on finance side, that need to be aligned so that there is enough investment for the new housing stock or new real estate. The importance of regulation is there. So basically, building codes and regulations to energy efficiency standards, by and large, take care of what needs to be done for new building. But the problem is the stock again, given that they are the ones where lower standards are locked in. So I think there is a very complex set of policy issues that needs to be dealt with, and that the crisis we're going through right now is a good moment to raise awareness about the need to have that type of conversation. There are very interesting policy initiatives at the level of Europe, for instance, the European Commission with the new energy efficiency directive and so on, that measures that go in the direction of addressing these split incentives, missing markets kind of problems. But there is a lot of scope for discussing this further. Maybe a topic for a future meeting with this group.
Thank you, Luiz. We definitely take note of this proposal. This brings us to the end of this SUERF workshop on housing markets in the 2020s. Thank you very much to Sylvain, Deniz, Anke, Manuel, and Luiz, and John for sharing your deep knowledge with us, and to all of you for your interest and for your participation. We wish you a very nice evening. Bye-bye and take care.